Onto your markets news now. Asian markets traded lower today, with some getting hit harder than others. This is economic growth worries prevail, and the coronavirus continues to cause uncertainty about the future. However, in China, there are hopes of more fiscal and monetary stimulus to help mitigate the impacts of the coronavirus. Japanese markets got whacked today, with the Nikkei share average closing down 4.5%. Over in Hong Kong, market sentiment was also subdued. The Hang Seng Index ended the day 2.2% in the red. China's markets closed on a downer as well, but losses were curbed by the promise of more coronavirus-related stimulus measures there. The Shanghai Composite Index ended the day down 0.6%. Over in the United States, markets there ended the last day of the first quarter in the red. Concerns around the economic impact of the coronavirus and its impacts on human lives continue to weigh on investors. The Dow Jones Industrial Average closed down 1.8%. The S&P 500 lost 1.6%. And the Nasdaq Composite Index ended the day 1% in the red. Well, after posting decent gains on the local equities market yesterday, the local market has reversed some of those gains today. But the extent of those losses are not as bad as what we've been observing on the European markets. Those markets are down around 3% or more currently. Volatility is the name of the game as uncertainty on a number of fronts prevails. Meanwhile, the local currency has also lost a bit of ground against major currencies. Platinum group metals like platinum and palladium continue to make gains, and this may have something to do with a number of PGM players indicating that they will not be able to honour supply contracts due to the current lockdown in South Africa. Let's take a look at the indicators. Well, for more on the markets, I'm joined via Skype by Makwe Masilela. He's Chief Investment Officer of Makwe Fund Managers. Thanks very much, Makwe, for joining us. Just give us a characterization of what happened in global markets, including our local market, in the first quarter, which was quite horrid.
It was just too bad, and good afternoon. I think global and local markets experienced their worst quarter ever since 2008, and all because of the coronavirus impact, and March made things just so worse. So as we're talking now, this is the first day, of the second quarter, and things are not looking okay because the JSE is just about to erase the gains that were made yesterday of almost 2.4%. But it continues to be the issue of coronavirus and oil also impacting on the global market. Maybe just to people realize that, we have seen a lot of companies back home here, saying they're no longer going to be paying dividends. And as you said, also the PGMs companies, that they won't be able to honor their contracts. And also in Europe, we saw the bank saying that they're going to stop paying dividends, and others are delaying those dividends. But the reason that will make markets go up is when a company makes profits, then the share price goes up. And also, more importantly, when the company pays dividends. So if you are not doing both two things, like getting profits or paying dividends, then there's no point for the share price to go up.
Yeah.
Hence, people are worried.
Of course, Makwe, we've had a lot of central banks around the world bring out their bazookas, bring down interest rates to almost 0%. We've had our very own South African Reserve Bank cut interest rates quite substantially by their standards, and of course also intervening in the marketplace to ensure that the banks are able to lend more money to us and so on and so forth. But despite all of these measures, and also fiscal measures, but not so much on the South African side, but globally, despite all the measures that have been put in place, there's still so much volatility. So ultimately, is it a case that until we see a vaccine or a cure for the coronavirus, we're just going to continue seeing this picture?
Definitely we are, because remember, what is this whole thing doing? They're just flooding the market with the money, and as a result, you'll have a lot of paper in the market, and hence you see the likes of gold keep on going up, because in the long run, this thing has a potential of being inflationary. So the situation here, because this is not 2008, because our problem is not financial, the problem here is this disease. So when you start addressing the disease, people start to see that at least you are making some progress. And remember also the statement that came out of Donald Trump yesterday, it didn't help the situation, because he said things are going to get worse for the next coming 2 weeks. So that itself, it shows you that we still have a very long way to go before we can sort out the disease. Yes, it's all well and good to pour money into this whole thing, but the real solution is for us to be able to get the vaccine, or also to start indicating that at least when it comes to the spreading of the disease, it has slowed down. Then I think markets will start to get a bit of a comfort.
Makwe, what's the PMI picture? A lot of countries around the world will be releasing their manufacturing data in terms of the Purchasing Managers Index. They must be quite bad, because a number of countries, or a third of the world, is on lockdown at the moment.
Yes, almost half of the world is under lockdown, and even the UN just stated that this is the worst, since 2000, since World War II. And we have seen the factory activities from the likes of Japan and South Korea posted their biggest decline in almost a decade. We've also seen the Britain numbers also not looking okay. So far, it has only been China which managed to come with positive numbers for March. We've seen the official PMI number yesterday. It was about 50 at 52. That was kind of pleasing and boosted market sentiments. And also the private sector PMI today is still above 50, but everyone else is just showing a bleak picture. And we expect the numbers coming out of Germany and also the US later in the day. But as you said, we don't expect to see any fireworks.
So, Makwe, I see that the interest rates on South African retail bonds have gone up quite substantially. I mean, for a 5-year bond, you get an interest rate of 11.5%. And just last month, that was at 8%. Just explain to us why this has happened.
It started with our bonds when we were auctioning them on Tuesday. Yes, there was demand. People continued to buy our paper, but at higher interest rates. Remember, we were downgraded on Friday. So there is a negative or an inverse relationship between the bond price and the interest that you are getting. So when you see the bond price going down, then you have to make up for that decline by making sure that the interest rates go up. And remember, since you are rated as junk, people will expect you to at least pay them more for them to loan them their money. Because with a bond, basically all you are doing, you are loaning the government money, and you are saying your government, you are just too risky, I'm going to charge you a higher interest, and hence the interest on those bonds of the yields had to go up to make up for the decline in the bond price. Now,
the interest rate differential between what you get on a bond return and what you get in terms of, and what the inflation rate is currently, somewhere around 4.5%, is quite wide. At a time like this where equities are so volatile, wouldn't this be a good place to put your money right now?
Hence, we see traders globally, they're running into government bonds. They see that as a safe haven. Hence, you see the U.S. treasuries, they continue to be in demand. So at any point in time when people are not comfortable, whether it's a crisis like this or geopolitical tension, then you see the likes of treasuries and bonds, people rushing to them as a safe haven. So yes, you are right. People are flocking into buying government bonds.
Makwe, thank you very much for your time, sir. That was Makwe Masilela. He's Chief Investment Officer at Makwe Fund Managers. We'll have more news for you after a short break. Do stay tuned.